Are you interested in learning real estate investing from experienced syndicators and industry professionals? Then you're in the right place. Hosted by syndicator turned attorney Gene Trowbridge, TLG Talks provides insights from guests who are excited to share how they've achieved tremendous success in real estate syndication and crowdfunding. Whether you're just starting out or have completed 100 deals, our guests have valuable insights for everyone. Thanks for joining us. We're glad you're here. And now, TLG Talks with your host, Gene Trowbridge.
Well, good morning, everyone, or whatever time it is. Appreciate it. This is Gene Trowbridge with Trowbridge Law Group, and there's a topic that's very timely that I wanted to pull in an expert and have a discussion about, and it's the topic of interest rate caps. So let me introduce to you the expert that we're talking to today, James Eng. There's James. Good morning, James.
Hey, Jane. Thanks for having me on.
Yeah, happy to do it. James is with Old Capital, and here's some facts about him. He's a Texan. I guess we can't hold that against him, and he's an investor. He's done a lot of business. I'm not even sure this slide is up to date, but it says
just add another billion on everything.
2.1 billion, 2.2 billion in loans. So, and quite a few of my clients use James and Old Capital. So I appreciate him coming on. This isn't the first time you've come on with me. I appreciate it. So I'm basically going to have three questions. The first question is to explain about an interest rate cap. About all I know about it, James, is when I see the sources and uses in a PPM. Some projects have an interest rate cap that people raise the money right up front and it goes to do something. What type of loans require interest rate caps and what does it really do?
Yeah. So interest rate caps on floating rate loans. Okay. So I would say probably when I started in the sort of on the multifamily side in 2015, pretty much everyone did fixed rate loans, right? So 2015 to probably 2019, 2020, everyone was doing fixed rate loans and you were fixed at 5% and you put the loan on, whether it's Fannie or Freddie, and you just moved on your way. You didn't have to buy an interest rate cap. You didn't have to do anything. And what happened was people, they didn't have to buy any interest rate caps at that time because the loan was fixed. But then all of these loans, when Fannie and Freddie, they have a penalty at the end of the loan called yield maintenance. So if you prepay a loan early, then you had to pay a penalty, and it could be 5%, 10%, 20% of the loan amount. So big numbers on the prepayment. And so starting in 2020, a lot of investors started going to floating rate loans. And the floating rate loans, at the time, the federal funds rate was essentially zero, right? So when COVID hit, it went to zero. And nobody sort of projected that the federal funds rate would go up. And it sat there for a long time. So when COVID hit in 2020, it went to zero. 10-year treasury essentially went to 1%. And it just stuck there. So let's say I was a borrower who was originating a loan or doing a loan in 2020 during COVID. You could go out and buy an interest rate cap at, let's say, 1%. So federal funds, the forward curve was essentially flat, zero. So if you're a bank and you're saying, all right, what's the chance of it going to 1%? Pretty low. So I'm not going to charge you that much money for this interest rate cap. So you could buy a 3-year cap at 1%. And it was $20,000 for 3 years. Now,
well, what would that cap buy me? What would that? Are you talking?
So that would protect you. Yeah, that would protect you. Yeah, no. So when you're getting a floating rate loan,
okay.
The way that they quote it to you. So on a fixed rate loan, they say, look, all right, your interest rate's 5% for the entire 10 years. So that's pretty easy. On the floating rate loan, they are quoting you a index and they're quoting you a spread. And so majority of deals, let's say we're around a 3 to 4% spread. So that 3 to 4% spread plus the index. So the index for a long time was LIBOR, but the index now is SOFR. And so SOFR is used pretty much across all Fannie, Freddie, bridge loans is SOFR, and it pretty much tracks the federal funds rate. So if you go on to Chatham's website or Pinsford's website and just put in SOFR forward curve, that's going to show you the historical, but then also what it's projected to do going forward. And so, at the time, if SOFR was, let's say, 50 basis points and your spread was 350, your all-in rate would be 4%. Okay. So most people would buy a cap at a higher number. So that strike rate, let's say it's 1.5% or 2%, that would cap your interest rate, right? So if you bought a cap on a 2% strike rate, that would cap SOFR, but your spread would always be on top of that, right? So you're putting a cap on the total interest rate that you have. And so most lenders required about a 2% strike rate in 2020. And that was fine. It wasn't that expensive. People bought the cap, and that limited your interest rate in terms of a max, right? So in the sources and uses, when you see, back in 2020, you might see $30,000 on a $20 million loan. It might only be $30,000 for the interest rate cap in 2020 because the forward curve was flat. Nobody was projecting that it was going to go above that. But now, so 2022, we've seen the federal funds go from 0 to close to 375 to 4. So right now, when we record this, is about 4%. It's going to go to 4.5%, maybe even 5% next year. And so you add that spread on top of, so let's say you get a loan at 300 basis points over. So your SOFR rate is 5 plus 300, your all-in rate is 8%. And so you can buy a cap at 2% still, but it is exceedingly expensive, right? So before it used to be, $20,000, $30,000. Right now it will be $500,000. It's almost 10 times the cost.
James, let me go back. When the loans were flat rates, was the interest rate cap designed to protect you against yield maintenance if you paid it off early?
So on floating rates, there is no yield maintenance.
No, I said when
the prepayment penalty is only 1%. Okay. So on floating rate, you have a 1. So this is the only reason anybody would take a floating rate loan is the prepayment penalty was significantly lower. So it was 1%. Okay. Whereas yield maintenance might be 5%, 10%, 15% of the loan amount.
So now we're on a floating rate loan, and I get a loan today that's the combination of the index and the 300 basis points makes it a 4% loan, right? And then I go out and buy an interest rate cap. Let's say I buy an interest rate cap for 3%.
Okay.
Does that tell you that I have an insurance policy that my interest payments will be made at any time that the interest rate is 7 or less?
So it is so the calculation is essentially what you bought. So let's say you bought it at 3%. So you bought a 3% strike rate. Anytime SOFR is above that, so let's say it's 4% right now. So they're going to pay that difference to the lender for you. Mm-hmm. So they're going to take that difference between your strike rate and the actual SOFR rate, and then times the loan amount, and they're going to pay that to the lender every month. So
would that be a 1% rate cap you bought?
No, it's not considered a 1% rate cap. The rate cap, the strike rate is the actual SOFR rate that you're capping your interest at.
Okay.
Yeah. So you're putting a cap on the index.
Okay. So yep. I guess what I'm trying to get to is I'm hearing through the grapevine that as these interest rates continue to go up, right, the interest rate cap that my clients bought is not going to protect them all the way.
Well,
right?
So there's two different there's two types of loans. One is Fannie and Freddie, and they are 10-year loan terms. And majority of people, it's a floating rate for the entire 10 years, but most people only bought 3-year caps. And so you're only protected for 3 years, and then you've got to buy a new cap.
Okay, let's stop right there. Okay. So I've been protected 3 years. Tell me when I would have bought my first. When would someone in what year
Would you buy the cap?
When
Oh,
would I?
it was required when you originated the loan. So when you closed on the property, you had to buy a 3-year cap.
Okay, so let's say I bought it in 2020.
2020. Yep.
2020.
2020.
Next
Yep.
year's 2023.
Yep. You got to
So
buy a new
I
one.
either have a new one more year or it's over and I have to buy a new one.
Yep.
Or
you refi.
you refi,
you
or
have
you pay the
you have
higher
to be
interest rate.
protected. Yeah, so it is required.
Oh, it's required. Okay.
So Fannie Mae and Freddie Mac, they usually looked at what is the property's NOI and what is sort of the maximum what's the maximum interest rate this property can handle.
Okay.
Right. So if the spread was 300 and they said, all right, let's use 2.5 as your strike rate. So the maximum interest rate would be 2.5 plus the 3. So you're 550.
Right.
So they said, look, this property can handle a 550 interest rate. So that's in the loan documents as that's the maximum strike rate that you can use. So the issue that's coming up is Fannie and Freddie require you the same way that loan servicers require property tax and insurance to be escrowed monthly with your payment. They require this to be escrowed monthly as well. So like we had a situation where they bought the property in 2020. The monthly escrow for the interest rate cap was $2,000 a month. Okay, that's good. This is a $20 million loan.
So some of my clients are raising all that money up front. They would raise $2,000 a month for 36 months and put it in the bank so they have it. Okay.
Yeah, that's okay. Perfect. So that worked, right? But then the escrow changed. So every 12 months, Fannie and Freddie looks at the escrow and says, is there enough money in there to buy this replacement cap? So when they originated the loan, it was $2,000 a month, no problem. We'll have plenty of money by year 3. Now they looked at it 12 months in and they said, hey, it needs to go to $30,000 a month. Okay, that's fine. $30,000 a month. Now I've got, let's say, $200,000 in the account. Well, now we've got 1 year left and it needs to go to $1 million, the escrow. And I've got 200,000 in the account. Now the escrow goes from 30,000 to 100,000
a month.
A month.
How does the property cover that? How does the property handle that? It doesn't.
The property can't handle it because the interest payment for the loan is $100,000 a month. So it's almost like having 2 mortgages on the property. And so this is going to become an issue for people. So they're going to either have to raise additional capital to make this payment, or they're going to have to move into a fixed rate loan, or they're going to have to sell the property. So there's really not that many options. I mean, you have to do something, right? Because most people can't feed a $30 million property every month if it's negative cash flow. And this is a requirement from the lender, the same way that they're escrowing property tax and insurance and your mortgage payment. You have to make this payment. So,
and if you don't, you're in default.
You're in default, and I mean, yeah, you're out of money. So either the general partners or syndicators are gonna have to put this money up, or a lot of people, now that 10-year treasury debt has come down a little bit, they're looking at refinancing into fixed rate, selling their interest rate cap, and then being able to just stay positive cash flow and then sell the property. And yeah, I've got a little bit of a prepayment penalty, but I don't have a negative cash flow for the next 12 months.
Is this only on Fannie and Freddie loans?
It is not. So Fannie and Freddie, they have a 10-year term, and they made you buy essentially a 3-year rate cap.
Okay.
On bridge loans, it's a little different. Most of those loan terms are 3 years, and they did not necessarily require you to buy a 3-year. Most people bought 2-year terms, 2-year rate caps, but they are not necessarily requiring you to escrow monthly.
Okay.
So you don't have that monthly cash flow issue, but at the end of the 2 years, where your interest rate cap is done, expires, you've got an issue. right? So if SOFR is at 5, and bridge loans typically were about 400 basis points over SOFR. So you're at 5 plus 4, that's 9%. And most properties can't cover 9%.
Right.
And so you're going to have a cash flow issue when your interest rate cap expires. That's number one. Number two is a lot of these bridge loans have some sort of debt yield test in month 12 or month 18, sort of halfway through the initial term, saying, hey, are you hitting your projections, right? Are you at 6.5%, 7% debt yield by month 18? And if you're not, they're going to start sweeping your cash. Mm-hmm. So pretty much everybody on a floating rate loan right now needs to be reducing their distributions or taking them to zero, because you're going to need this cash while we wait, right? The next year is going to be pretty tricky for operators because the liquidity at the property level is going to be significantly down.
Yes. So if a lot of the clients used 3-year with 2 1-year extensions on their bridge loans.
Right.
And then they had this chunk of money that they raised from the investors, which is kind of interesting because if you're paying a preferred return,
right,
you're paying a preferred return on that money that's sitting in the bank to be used for your escrow payments and your interest rate cap.
Right.
That in itself will dampen your return on your property. And now, after 3 years, would they automatically get the 1-in-1 if they can't? No, they'd have to prove that they can make the payments, right?
Yeah, usually it's a test, right? So usually there's some sort of, whether it's 8%, 9% debt yield on the extension. And so let's say you had a $20 million bridge loan and you test your NOI and you get to a 7. And the lender says, well, you don't qualify. So you're going to have to pay down the loan. So you might have to pay the $20 million loan down to 19 or 18 to get it to size, and then they'll extend it, right? So a lot of these deals, they might have what we call a cash in refi. So you're going to have to bring additional cash. Instead of a cash out refi, it's going to be a cash in refi on a lot of these deals, especially like the Fannie and Freddie loans. They were done at a 125 debt service at the time. Whereas a lot of the bridge lenders, the initial loan was not based on 125 on in-place income. It was based on a pro forma income. And so if it's based on a pro forma income and you don't hit that pro forma income, then it's going to be difficult to refi that loan at the exact proceeds that you took out.
Mm-hmm. So my mind is just racing through my capital call provision in my documents that I draft. So people are going to pay more attention to those capital call provisions on new offerings that we do, because this is going to, as long as interest rates are going to be high, this is going to be something that we have to look at. I think I need to put in my risk section of my PPM the risk that the interest rate cap won't cure everything for the whole holding period of the property or the period of the loan. And then people have to be comfortable with that. People don't like capital calls. Generally our documents, James, say that if you're getting a situation, the first thing you can do is you can borrow money from someone else. The second thing you can do is the manager can advance funds. And the third thing is the capital call, because that's the one that's least likely to happen. We probably have a provision that 75% of the Class A units will vote to approve a capital call, but no one has to invest. They're just,
you can approve it, but you don't have to invest.
They're sitting there.
We need the money.
Waiting for the big guys to invest, right?
So in that first provision, when you say borrow the money from someone else, what does that mean? Because we're getting calls unsecured. Like, where would that come from, though? Like, who's gonna?
Well, first of all, it could come from members, not in the form of a capital call. You could just go out to the rich members and say, you know, we're going to need to raise $1 million. Can I count on you for 100,000?
And do you set up, is it like a different class then? Do
no,
they get
no, it would be a
different?
note, and you'd give them a note, and then that note would, the terms of the note would be they're going to get paid back before any other distribution is made, and it's not going to be secured. But you know, a lot of lenders don't allow that anyhow.
Right. Yeah.
So we kind of miss that. So then we're down to the manager's advance, and a lot of lenders don't allow a manager's advance. So then now you're down to the one way out of this problem. Keeping the property is capital account. And the next way out of the property is getting rid of the property. So what do you think is going to happen here in the next year?
Well, you know, if the longer that the Fed, number one, they see a slowing of the hikes. So that's like the beginning of the end a little bit. So if we see a slowing of the hikes and we top out at, let's say 5.5, and they pause, that's going to bring down the cost of these interest rate caps significantly. Once they see the pause, because the pause usually leads to a cut, and that's going to save a lot of people. But in the meantime, for the next 12 months or so, it's going to be a little bit of a slog, because with rates at 5% on SOFR, you know, everything's expensive, right? And so what we're recommending to a lot of clients is like, look at your monthly cash flow, figure out what your interest rate cap costs are going to be. And you have to almost prepare for the worst. I mean, nobody thought it was going to run 400 basis points this year, federal funds from 0 to 4 in 1 year. So, I mean, you've got to protect your downside. And what that means for some people is you've got to extend the time that you're in this deal. And for most people, if they sell a deal after 12 months or 18 months, more than likely the limited partners are going to lose money on this deal, because it's just not the right time to sell a deal right now. Unless if you've held the deal for 5 years or 10 years and, you know, you didn't sell at the peak, but it's down a little bit, that's probably fine. Right. But if you bought a deal at a 3.5 or 4 cap, and now you sell at a 6 cap, you did not make money on that deal.
No, a lot of people did that too. You know, I talked to a lot of my clients who called and said, boy, you know, we bought this property and it's been 18 months and we get capital gains and we exceeded our goal of a 3 or a 4 year hold. We're going to sell right now. And I said, you know, first of all, what are the people going to do with the money when you give it back to them? You know, if it's a good property, why don't they leave the money in the property? And this it isn't designed to be a short-term flip industry. So I think you made a mistake there, but
it's moving the opposite way right now. So that's the tough thing, is that in
that's not
18,
work
18 and 19, if you held it for 2 years and you sold it in 2021, cap rates went down in your favor. Now cap rates are going the other way. Yeah. And so it's cap rates are going the other way and interest rates are going the other way.
You know, people, as an observation, some people might be saying, well, this is a terrible market. Those of us who have been around a long time would say the market where you were dealing with 3% loans and 4% cap rates, that was an exception. That was an exception to the rule. For all the years I've been in the business, there's just a short period of time where interest rates have ever been below, you know, 7 or 8%. That's the norm. We're back into, in some regards, into a normal market historically for me and in my experience with real estate over the last 50 years. I bought my first house. You've heard all these stories. I paid 13%. Now that was a blip. Okay. 3% was a blip. So yeah, you didn't have to be a magician to buy.
I mean, what's gonna hurt people is if you sell when you have to sell. Right. When you're forced to sell, let's say you're in that situation where your negative cash flow, $30,000 a month, someone's got to come up with that money. right? And if that's, that might be one deal. Some of these guys have 20 deals, right? And you can feed a couple deals, but you're not going to be able to feed all these deals.
Sure, and that's just the 30. That's just the reserve for the interest rate cap. That doesn't cover anything else. So that's going to be a challenge that we're going to have to work with. So getting new loans going forward, what are you telling your clients about getting new loans and how they're going to have to deal with this interest rate cap problem?
Yeah, I mean, Fannie and Freddie are anywhere from about 50 to 60% levered. Right now, their rates are about 200 over the 10-year. So 10-year, let's say, is 375. Your fixed rate is 575, right? And so most people, if they want positive leverage going in on a fixed rate, they're going to have to buy something north of a 6 cap. Right. So that's where the pricing is going, but it's going there very slowly, right? So if I'm a seller and 12 months ago, the broker was telling me, I'm going to sell this deal for $20 million. And you're like, all right, let's go. Now they're telling me I can only sell it for 15 million in like 9 months or 12 months later. Most sellers are saying, I'm going to just hold. I'm going to sit here. I'm not like, yeah. So there's not as many transactions happening right now, right? In the beginning of the year, there might have been 40 or 50 deals on the market in DFW. Right now, there's like 4, right? So the amount of volume that's transacting right now, there has to be a very motivated seller or very motivated sort of 1031 buyer, because nobody is really transacting unless they have to right now.
And hopefully the 1031 buyer has a lot of equity, so they can get in there at a 50% leverage.
50 to 60% leverage. Yeah. I mean, Fannie and Freddie, they're going to be 575 to 6, 50 to 60% levered. And then there are bridge loans still out there. But bridge loans, you're going to be 7, 8, 9% interest rate. And so bridge loans are only going to be used right now for an absolute necessity in terms of it doesn't qualify for Fannie Freddie. And the other thing that people are using right now is all the loans that were done in, let's say, 19, 20, 21 on a fixed rate basis at 3.5 to 4.5%. Those are all assumable. And so people are taking those loan assumptions and then potentially adding a supplemental, or they're just raising the capital. So if you put 35% down, you assume the loan at 65%, then you can go on your way. You've got 8 years left at 3.5%. And so that's probably going to work out in your favor, right? Because that debt is an asset. And sometimes those people are buying at lower caps because their interest rate is lower than market. Their interest rate might be 100, 200 basis points lower than market right now.
When was the last time you saw an abundance of seller financing in your market?
More on smaller deals. So I would not say on these larger $20, $30 million deals, the seller's really sticking around financing most of it. If they're, and whether the lender allows that or not is also a concern, right? So most Fannie and Freddie lenders, the seller can sometimes stay in as a limited partner, but they don't necessarily want like any type of note behind them.
Sure.
Some Fannie and Freddie lenders allow preferred equity or mezzanine piece behind it. And so that might come into play more so where Fannie needs a 125 debt service coverage, and then they allow a mezz piece that maybe gets it to 110. But it's gonna, I don't know if it's gonna make up the entire difference that is needed. And so some sort of capital call might be needed to do some of these refis.
What's the cost of an interest rate cap today?
So an interest rate cap is all dependent on the strike rate that you choose, right? So let's say you use a 3% strike rate. So I just pulled this up, 3% strike rate on a $10 million loan for 3 years. Okay. So 3% strike rate, let's say your spread is 400 over, right? So 3% plus 4. So your all-in interest rate is going to be 7%. It costs about 4.5 to 5% of the loan amount. So if the loan amount is $10 million, your cost on a 3% strike rate is about $450,000.
And that only buys you 3 years of protection.
It's 3 years, right? And so on that on that, so we'll use this as an example. If $10 million at 3% strike rate, based on the forward curve right now, that is going to pay you about $300,000 over the life of the cap. So that's why it's so expensive. Is because day one, SOFR is already 4%. So they're going to take 4% minus your 3, that 1% times your loan amount, and they have to pay you that every month already. And then as it goes higher, they're paying you a bigger number. So, and then you're using that to pay your interest to your lender, right? So, so the banks are, I mean, it's just really expensive right now on these interest rate caps. And so as soon as we see a cut, hopefully that relieves some of the pressure, and the curve is underneath that strike rate.
Interesting. And is 3 years the maximum you would get because of the cost or because of the product, or you keep
I mean,
3 years?
Yeah, I mean, after this last year, I feel like people are going to be a little bit shell shocked on these floating rate loans a little bit. And it might, yeah, I mean, if you can buy a 4-year or 5-year, what usually happens is the further you go out, there's more uncertainty. And so the cost usually doubles every year. So if you go from a 3-year to a 4-year, it goes from 500,000 to $1 million. And, you know, most of these deals, people are holding for 3 to 5 years, and most people don't want to raise all that money. And then you pay. So when interest rate caps go up, so you bought a cap for 25,000 in 2020, and now you've got a year left. Some of those caps are worth like $500,000 because they're in the money, right? They're getting paid out. And so you can actually, if you refi out of your loan and go to a fixed rate, you can sell that interest rate cap and capture that $500,000. And so, but if it goes the other way, if you buy $1 million cap and then the Fed says, actually, we're going to cut rates now, and then the value of that cap goes down, you could get zero. So, okay. Yeah. So it goes both ways, but it's very tricky right now.
So are you predicting that every Fannie and Freddie loan that you write for the near future is going to have an interest rate cap?
If it's floating, it's required. If it's floating, they're requiring either a 2-year or 3-year rate cap. And then on bridge loans,
what's the fixed rate on Fannie and Freddie?
It's about 200 over 10-year treasury. So 10-year treasury is about 375. So 200 over, you're at about 575 right now.
So if you bought a fixed rate Fannie and Freddie, you wouldn't need the interest rate cap because you're
no interest rate cap. Yeah.
Okay. And that's also the protection of it going to 7. So
yeah, it's protection. Yeah, it's protection of it going up. The tougher thing is if it does have a yield maintenance penalty, then if the Fed drops rates and 10-year treasury goes back to 1%, then you have a big prepayment penalty, right? So it limits your upside. And so
well, you just have to hold it for 10 years.
Yeah. I mean, most people aren't going to hold it for 10 years, but you know, the way I like to say it is, when you get a floating rate loan, you hate your floating rate loan every day until you pay it off. Because when you pay it off, it's only 1% prepay. But every day before that, you hated it, right? Because you had to deal with this interest rate cap. You had to deal with the uncertainty of it going up and down every month. On a fixed rate, you love it every day, except for the day that you pay it off. And you pay it off, you could have a big penalty. And so the best, I mean, from what I've seen, is if you pay a little bit higher interest rate, you can get what's called a step down prepayment. Step down prepayment is, it starts at 5%, goes down to 1%. And on a 10-year, it basically goes 5, 5, 4, 4, 3, 3, 2, 2, 1, 1. And that's a percentage of the loan amount. And so that sort of quantifies your prepayment penalty. And you pay probably about 20 to 30 basis points more on Freddie Mac to do that fixed rate step down. And so if you're not sure, that's probably where I would lean to. If you're like, hey, I don't want to deal with the volatility on the floating rate anymore, I just want to get a fixed rate, but I don't want to get stuck with a yield maintenance penalty, that's usually a good in between to go with the Freddie step down.
So we're going to wrap this up. I appreciate it, but one last question. Looking in your crystal ball for both you and me, do you believe that our deal volume will be a little slower next year than it was this year?
This is my hope is, so we did probably about 1.2 billion at Old Capital and loans, and majority of that was first and second quarter of this year. Third and fourth quarter are going to be light. There's no doubt about it. The first and second quarter of next year, I think, are still going to be light in terms of transaction, but my hope is the third and fourth quarter will be a lot higher. So I think once the Fed comes down on rate, hopefully the 10-year Treasury goes down as well, and that's going to set a lot of these deals back up. So once interest rates get back around 5% on the fixed rate side, a lot more deals can transact, a lot more deals can refi. When 10-year Treasury is north of 4, it is very difficult. Mm-hmm. But when 10-year Treasury is at 3% and you add 2%, so you're all in rates 5 on interest rates, that is a very, I would say, healthy number for people to transact at and refi.
That's still an attractive interest rate given the history
for sure.
Multifamily. So that's great. So we've been talking to James Eng. James is with Old Capital, and his direct phone number is 214-300-5035. 214-300-5035. So James, what's your email address, James?
It's on the slide there too. It's JENG. So JENG at oldcapitallending.com. And if you just go on Google and type in my name, there'll be plenty of stuff.
Yeah, that's for sure. Are you going to have your big event next year, do you think?
Oh yeah. Now that COVID is out, I mean, last year was great. We had probably about 550, 600 people down here in Dallas. Usually we try to have it in September. So September of 23 will be the next one.
Well, I'll be there. I couldn't make it this year, but I know that Dave and Jonathan were there.
Oh yeah,
They love the event, and I've been to all the other ones. So if I don't see you again, I'll definitely see you then, James. Thank you.
All right. Thanks, Shane.
Bye.
Thanks for watching. Please consider subscribing to the channel and liking this video. Leave a comment below to let us know you enjoyed the interview, or leave a suggestion for a future guest. If you'd like to be a guest on the show, please contact us by emailing talk@trowbridgelawgroup.com. And if you're ready to talk about your syndication deal, visit us at trowbridgelawgroup.com to sign up for a free, no-obligation 30-minute consultation. As always, keep learning, keep earning.